Good afternoon, everybody, and welcome to our last session of Essentials for the year. My name is Dale Franklin, and it's a pleasure to host you today. This is a very special Essentials because we will try and unveil our crystal ball and give you some of our views of what we can expect for 2023. Presenting today is Nolan Wapenaar, who's our Co-CIO, Peter Little, who's the fund manager at Anchor, and Casey is our resident economist who will give you some macro views. And if I could ask all of you, please try stay to the end if you'd like the CPD points. If you log off early, you won't get it. And if you do have any questions, please put it in the Q&A function, and I will handle all of them at the end. So without further ado, I'd like to hand over to Nolan, and I'm sure it'll be a great session today. Over to you, Nolan.
Thank you very much, Dale. Hello, everybody. Dale has already introduced me, which I appreciate. I'm Nolan Wapenaar, Co-Chief Investment Officer here at Anchor Capital, but really, to all intents and purposes, I'm the guy who's responsible for fixed income. Today, we're going to look at it a bit differently. I'm going to talk about some of the things we're watching in the sort of European region. Peter Little will then talk about the US and the Chinese regions, and Casey will bring it home with a bit of a discussion of domestics. In terms of looking into the future, I think certainly from my side, a lot of what we're going to talk about is the ripple effects from 2022. We've had quite a number of big surprises, big events this year, and they're going to have a sort of continued impact looking forward. But before we do that, I actually thought a nice starting point would be to look till just tomorrow. And tomorrow, NERSA is going to be sort of announcing the Eskom tariff increases, or at least the first round thereof. And an interesting infographic from the Visual Capitalist, where, if you look on the top right-hand corner, you'll see the sort of average cost of electricity throughout the world is about 14 US cents per gigawatt or per kilowatt hour. And then you look at different countries and you can see where what the effective cost is. South Africa has moved from being a cheap producer of electricity to actually we're in line with the global average right now, and potentially tomorrow will be on the expensive side. So, that just gives a bit of context for tomorrow's discussion. What are we looking for? What would bring a bit of Christmas cheer is a little bit of sensibility from NERSA. South Africa can't be a high-cost producer of electricity. And at the same time, Casey will pick up on some of the structural changes that we are actually looking for. But flipping across to Europe. And what I've got here is a chart of inflation rates across various European countries. The blue bar is inflation this year, and you can see inflation has pretty much averaged about 8%, way too high. And you can see the beige bar, which is where we think inflation will be next year. The good news is inflation is coming down. That is good for investments. I think it does give a boost to investments all around, and we expect a better year next year than we've had this year. That's for certain. Looking at the beige bar, though, why is it coming down? And there are two factors. One is base effects at the moment. We're seeing a lot of commodities like oil prices coming down, coming lower. Oil was at $120 a barrel. It's down to 90 now. So that trend is actually helping bring inflation under control. And the second one is central banks have reacted. We've seen higher interest rates. And I just want to talk about higher interest rates in Europe. So what we've got here on the left is a chart showing you the debt to GDP ratio, how much debt various European countries have got. And France, Italy, Portugal, Spain, debt well over 100%, with Italy at 140%. Put that in context, South Africa's debt level is about 70% of GDP. Italy is running about double the debt load that South Africa is. Now, when interest rates were zero, that didn't matter much, because the cost of debt was free, and therefore you could comfortably run 140% debt levels. Unfortunately, debt is no longer free. And as a result, Italy's budget is going to start to need to factor in greater and greater interest payments. And this is of concern in Europe, where suddenly that debt burden is going to come home to bite. And we are watching that quite closely. Coupled with that, if you look on the right-hand side, you'll see sort of expected growth rates for the various countries from the IMF. And interestingly, the country like Italy, that's got the biggest sort of debt challenge, is also talking about a recession next year. So they're not going to grow into their debt, and they're going to need to adjust the budget in a difficult environment. Market is looking at that at the moment and saying, how do we react to it? And the market is basically increasing its risk aversion towards various European countries. So what we've got here in the sort of dark blue shorter bars is the cost of insuring against default of various countries' debt last year. And then the lighter blue bar, the bigger bar, is the cost of insuring against that country this year. And you can see the cost of credit insurance has gone up, if you want, across the board, but it's going up most for the countries that are sitting with a higher debt loads. So the market is starting to say we have some concerns around the sustainability of what's going on in Europe, and and the ability of the European government to work its way through this. Concern for the ECB is they know this. So you talk about rising interest rates, hiking interest rates. They're hiking into a softer economy, and they're hiking into a fragmented environment that could fragment further as they hike. So they are a lot more cautious on their hiking, and that means that bringing inflation down is going to take longer. In fact, they came out today saying effectively that the European inflation is going to be higher for longer. It's going to take a slower glide path down, but it is going to get there at the end. So what are we really looking for? And the European government, if you look at what happened in Russia, their reaction to the Russian invasion of Ukraine, it was a very, very harmonious sort of, the Europeans came together, they acted as one, there was unity. And that was a level of unity that we haven't seen from Europe before. It actually surprised probably Vladimir Putin as well. And that we are looking right now, if Europe can actually take that unity that they've got and now sort of expand it to other things like managing inflation down, managing some of the fiscal imbalances that do exist within Europe, they are going to come out of this significantly stronger. From an investment perspective, we're actually expecting a stronger euro, more to do with a receding dollar. And at the same time, we do have companies in Europe that look appealing. A lot of them are sort of worldwide businesses that happen to be headquartered in Europe, and we continue to find some of these attractive. I mentioned Vladimir Putin previously, and looking at Russia, he went into a war probably on poor information. He expected a 3-day war. He certainly didn't get it. And that puts him in a very, very difficult situation. So what are we really looking for? We're looking for a cessation of the hostilities. We'd like to see peace come through. The problem he's got is that no Russian leader, whether you want to call him a Tsar or a PM, has ever lost a war and lived. So from his perspective, it's a very, very difficult position that he finds himself in. And one gets the sense that over time, he's looking for a sensible exit to this. The thing is that a lot of people in Russia are aware of this, and there's a power struggle developing below him for potentially being the next leader. And there are a lot of people who are clearly positioning themselves, but I've mentioned 4 of them here. And the point I'm making is none of these people are nice people. So you've got Nikolai, starting on the left, you've got Nikolai Patrushev, and he is running the FSB at the moment, effectively the spy agency from which Vladimir Putin came as well. And that gives him immense control over the sort of intelligence apparatus within Russia and then a control over the people. So he is putting up his hand, obviously come from quite a dark background, and pushing. His son, agricultural minister in Russia, is also positioning himself, and he comes with a sort of slightly more moderate reputation, but he obviously is able to, as a family business, almost work with his father to, control the clandestine side of Russia. 2 other people who are positioning themselves, the Chechen leader, Razman Kadyrov, who's openly saying that Russia should start using nuclear weapons, and the founder of the Wagner Group, essentially with his private army, which is what the Wagner Group is, Yevgeny Prigozhin. So from that perspective, we've got a number of the faces here that you might start reading about more and more in the newspapers. And the point is that to position themselves to take over, they're doing it by basically trying to be the sort of strongest man, arguing that Putin hasn't gone far enough, that he should be more aggressive, that he should be more brutal on the Ukrainians. There's very little voice at the moment for a softer approach. And that is of concern. At the same time, the other concern is that the conscription has not been well received. And a lot of the sort of far-flung regions that are seeing their children, their husbands being sent to the war are pretty angry about this. And there is definitely a risk that at a time that the Russian military is weakened, that you see a fragmentation of Russia. Again, that's not a very happy outcome, because in that sort of environment, you've got potentially sort of regional warlords springing up who may or may not have access to nuclear weapons on their particular territory. So from that perspective, there are certain sort of bad outcomes to war's end that we do need to be aware of. The point, though, is that the path towards a good outcome is actually quite narrow. It certainly is there. But what are we looking for? What brings sort of joy to us is either war's end of hostilities, and at the same time, Vladimir Putin is able to sort of hang on and sort of gradually pull it together, eventually handing over to a more moderate, or otherwise that a more moderate, perhaps Dmitry is the most moderate of the people I've spoken about, is able to sort of ascend to power, and that he's able to hold it together and push things forward. But certainly it's something that we are keeping an eye on. Finally, from my perspective, just turning to the United Kingdom, I think that they've been a bit of disarray of late, a couple of prime ministers very quickly. And the chart on the left is showing the business or the UK budget deficit. And the point is that if you look at what happened with that pink line at the end, it sort of juts upwards. Liz Truss's strategy was to say the economy is in trouble and we'll spend our way out of it. Financial markets absolutely hated that message. It cost Liz her job, and in came a slightly more austere people, and we've effectively got an austerity budget. So the UK finds itself where it's in a position where it's got an austerity budget on top of what was already a very difficult economic position, and we expect a protracted but hopefully not too deep recession in the UK. If I look on the right, what does that really mean? And on the right-hand side, if I look at the black line at the bottom, you can see effectively the percentage of the economy that's been taxed. So the tax burden on the economy, and that's been down as low as sort of 30%, pushing up a bit of in the 2000s, and that's now going to push to 37.5%. So 37.5% of the economic production is effectively taxed. The point is that's the highest it's been since World War II. And, we can talk about the Conservatives having a small government. They've been put in a position where the tax burden is going to be very significant on people, on top of all of the other challenges that we've got. And above that, you've got the blue line, which is the government spending line. You can see how they're projecting to bring that down over time. And the first point is that the government never brings it down as per intention. There are always unexpected expenses. And the second point to make is, even with all of that coming down, you've still got about a 5% deficit per annum in the UK, which is too large. So the UK is going to be under a lot of pressure to get its finances under control at a very, very difficult time. And that comes out firstly on the left-hand side. You can see how the UK was planning on issuing debt, and the debt projections of what they needed sort of increased. The highest bar was Liz's budget. And then the latest sort of revision to that doesn't take us back to where we were. It just trims it down a little bit. More importantly, on the right, you can see how the debt to GDP of the UK pushed up to 100%. Again, remember, South Africa's only at 70, and then pulls down again. So the UK has got some hard decisions to make, and what we really are looking for is some sort of economic structural plans as to how they're going to deal with Brexit. I think they haven't totally digested the consequences of Brexit yet. We're looking for plans on their labour market. I think as a consequence of Brexit, they've tightened the labour market too much. We've already seen people calling for the labour market to relax. And hopefully what we're looking for is a recession that isn't too deep, and that as they come out of that, the UK becomes a lot stronger. In terms of investments, again, we think that the pound may benefit from a weaker dollar, but we also think that, when we're looking at UK companies, we prefer companies that are earning global revenues rather than British-based revenues, and that we're looking for pockets of opportunity as such. With that, I'm going to say thank you very much, and I am going to hand over to Peter Little. Thank you.
Thanks, Nolan. As Nolan said, I'm going to be talking about the other major global economies, so the US and also China, and obviously with a view to looking into what's going to be happening next year. So let's start off with the US. Okay, that's the world's biggest economy, but in terms of economic activity, it punches even higher above its weight in financial markets. So about half of global listed equities are listed in the US, about half of global bonds are issued out of the US. And so it's not only a significant economy, but it's a really significant pillar of the financial market. So for investors, what happens in the US is particularly important. Now, I think we're reaching sort of broad consensus that best case scenario, the US economy won't grow next year, and a more likely outcome, or an increasingly more likely outcome, is that we might see the economy tip into a recession. So I thought I'd just take a step back and look at kind of the pillars of what drives economies into recession. So starting on the left-hand side here, most of the time, so circa 80% of the time, we see economies growing. And they grow in these kind of virtuous, self-fulfilling cycles. So, for example, you start with employment rising. That means people are earning more money. When they earn more money, they're able to buy more stuff. So corporate sales start to climb. When companies are selling more stuff, they have to produce more stuff. And in order to do that, they typically have to employ more people. And so employment rises, income rises, and so we go on. And then at some point, this sort of virtuous expansionary cycle falls over. And as I say, this happens very infrequently, but it does happen from time to time. We think in terms of when that's going to happen, very likely happens in the course of next year. So on the right-hand side there, you see this kind of virtuous cycle reverse into a vicious cycle. And so as employment falls or income falls, sales falls, production falls, and this kind of it creates this downhill spiral. Now, at this stage, I think financial markets have already sort of baked in a fairly dire outcome for economic growth next year. So even if this US were to go into recession next year, it's not necessarily saying that we're going to have a pretty bad outcome for financial markets. I think the impact for financial markets will really be on how deep that recession is. And for me, how deep that recession is has less to do with the kind of pillar that falls over and kicks off this vicious cycle or this kind of contractionary cycle, and more to do with whether that cycle actually exposes some credit bubbles. So, for example, on the right-hand side of the slide here, the two sort of dark blue pillars of this economic cycle, employment and income, which relate to the consumer. If employment shrinks or people's income shrink, and this exposes sort of over-indebtedness in consumer finance, that can create some problems for us. And likewise, on the sort of light blue pillars of that economic cycle, to the extent that companies see their sales and production falling and profits falling, that can expose some over-indebtedness in the corporate side of debt. And to the extent that these things happen, to the extent that they expose credit bubbles, that usually impacts on how deep these recessions are. So we'll talk a little bit over the course of the next few slides of whether we see that happening. So starting off with just looking at those pillars and which ones might be susceptible to falling over and pushing us into a contractionary cycle. If we look at the labor market now, the chart I've got on the left-hand side here, this is obviously all for the US, is showing that the labor market has become more and more dependent on an aging workforce. So 20 years ago, only about a quarter of labor supply was coming from people aged 55 and over. Now we see that that's almost 40% of the labor force is aged 55 and over. And that's caused some problems after the latest kind of COVID shock that we've had. So on the right-hand side here, you can see sort of the labor, as the labor market grew, the portion of the labor market being supplied by that aging demographic was growing and growing. And then when the COVID pandemic hit in the beginning of 2020, that catalyzed a lot of people to just pull back from the labor market in this 55 plus cohort. So a lot of people who were either close to retirement age or had been kind of lingering around, waiting for a retirement decision, just decided that's it. And we sucked about 3 million people out of the labor force in the US as a result of that. So it becomes particularly the US labor force, which is aging, becomes particularly susceptible to these kind of shocks that catalyze these lifestyle decisions for an aging workforce. And so the outcome of this is that we have a really tight labor market at the moment, which I think will act as a bit of a safety net for the US economy. So as companies start to think about protecting their margins and retrenching people to cut their costs, they'll be a little bit apprehensive about this and kind of give it a bit of thought, so that because it can be difficult to find people to work for them again. So we think this will provide a bit of a safety buffer for that employment pillar of the economy. If we move on to that kind of spending pillar of that economic cycle, obviously Americans are now well employed. They're getting good incomes. They're pretty positive about the employment prospects. So that's helping drive spending. What else is helping? Well, so spending on the left-hand side of this chart was kind of on a solid growth trajectory heading into the COVID pandemic. And then obviously as the pandemic hit, people weren't able to spend on things. They were a bit worried about the future. So they pulled back on spending, and consumer spending really fell off a cliff. And what that did is it started sort of forcing some savings. So people were over saving at this point. So on the right-hand side here, this chart shows that Americans in this blue line chart were saving at about, they typically save at a run rate of about $1 trillion a year. And then at the start of the pandemic, on the right-hand side of this chart here, you saw spending pull back. And so saving obviously increases. On top of that, you had the government step in and throw some stimulus at people. People received checks, extended unemployment benefits. So savings really spiked. And by our calculations, in the first sort of year or so of the COVID pandemic, Americans saved an additional about $2.5 trillion over and above their normal savings. And over the course of the last 6 months, we've seen them start to dip into that. So the strong employment prospects plus excess savings are really driving sales and helping that kind of virtuous cycle of economic activity kick off. As I say, Americans have started to dip into their savings. Their savings rate is less than half of what it normally is. And so they're starting to eat through this excess savings amount. By our calcs, at this pace, those savings will last another 12 to 15 months. So this is quite a good run rate from spending, from employment and particularly from these savings. So that pillar looks pretty solid for now. But the reality is that if Americans keep spending at this rate, it's creating problems for inflation, and the Fed can't live with inflation. Inflation is very bad for economies. It tends to become psychologically entrenched, and then it's very hard to get rid of. So the Fed is working furiously to try and cool inflation. And the way that they do that is by trying to kill demand. So they want people to stop spending. And in order to do that, they increase the cost of money. So they say, the incentive to save is much higher because your rate on savings is getting much better. And also your incentive to borrow money to spend is getting much lower because it's getting more and more expensive to borrow money. And so they're desperate to kill off that kind of sales and spending growth that's part of that virtuous cycle. And what I've shown on this chart is just kind of the pace with which the Fed are attacking the spending growth. So this chart shows the Fed tightening cycles over the course of the last 30 or 40 years. And the one that we're currently in is this red chart over this red line over here. So Fed have hiked rates by about 4%. The axis at the bottom here is time. So it's taken them about slightly more than 2 quarters, slightly more than 6 months to raise rates 4%. We think they'll keep going, but probably about another percent. So over the course of about 9 months, they will have hiked rates about 5%, which is pretty aggressive, not only in terms of the quantum, but how quickly they've done that. So they're taking this pretty seriously. And that's why we're reasonably confident that it's going to start having an impact on spending going into 2023. And we will see that economic cycle slow down. Again, as I said, the critical part for us is not that it slows down. We think markets are already preempting that. It's just whether that exposes any excessive credit bubbles and causes an extreme slowdown. So along those lines, if we look at just the components of US debt, so we've got, for example, in this dark blue line at the top here, this is debt within the US banking system. And this obviously got completely out of hand in 2008 before we had the collapse of Lehman. The banking debt or the leverage in the financial sector has come off pretty dramatically. So we're less worried about the banks causing a sort of debt bubble. Consumers were the other problematic debt build-up going into the previous major recession in 2008. So consumers were getting pretty over-leveraged, mostly on housing mortgage debt. And that's come off pretty dramatically too. So we're less worried about the consumer debt build-up here and some, excessive consumer debt being exposed when the economy slows down. The one in the dotted line here, this is US corporate lending. So this has been sort of gradually heading in the wrong direction. And it's not excessive, probably by any stretch of the imagination, but it's probably the one out of those sort of consumer, out of those potential credit bubbles that's likely to be more exposed. So, but here we're not particularly worried. So in terms of the depth of this recession, we're not too worried about consumer and corporate debt being a major driver of a very deep recession. The line chart that really sticks out here in red is the US government borrowing. Well, that's got pretty excessive. Obviously, part of the stimulus that they dished out over the course of COVID was funded by borrowing, and so the U.S. government is really kind of over leveraged at this stage. The good news is, though, that that's unlikely. I mean, they're unlikely to default when the economy slows down. The U.S. government can kick that can down the road, and ultimately it will be a drag on some point in the future, but it's unlikely to cause this major problem during what we see as a potential U.S. recession or slowdown next year. So that's the good news on the U.S. We think there's a lot of sort of bad news priced in there, and we think it's unlikely that we'll see an extreme recession next year. Let's move to the other major economy, so China. And just to start off with, I've just said here that it's too big to ignore. So what I've got on this chart for the various major economies is the proportion of global economic output that they represented 20 years ago at the turn of the century and what they represent now in these sort of light gray bars. And if you look at China at the turn of the century in 2001, it was less than 5% of global economic output. At that point, it was smaller than the UK economy. Now it's in the high teens, and it's grown to be bigger than both the EU and UK combined. So it's slightly smaller than the US economy, but comfortably the second biggest. And as a result, the economic engine out of China is very hard for us to ignore. With that context, what happened recently in China is a little bit unsettling. So we had some leadership, I want to call them elections, but a leadership conference in China a few weeks ago. And the outcome of that for certainly for us as a kind of Western market-friendly societies was a little bit uncomfortable. So starting off on the left-hand side here, I've got a chart or a table just to put the Chinese population into perspective. So there's about 8 billion people in the world, and roughly 20% of those live in China. Of the 3/4 of the Chinese population that are adults, just less than 10% of them, or about 100 million people, are members of the Chinese Communist Party. Now, China is not a democracy. You don't vote for your leaders in China. The Chinese Communist Party runs the country, and the members of the Chinese Communist Party decide who runs the country. So every 5 years, they send about 2% of their members, or like 2,000 of those 100 million people that are members of the Chinese Communist Party get together to decide who's going to be the ultimate leadership, who decides the trajectory of the Chinese economy for the next 5 years. That, as I say, happened fairly recently. Their first step is to elect what they call a central committee, which is about 370 people who will be the leaders within the various regions around China. Now, once they've elected that, they take 25 of those people who essentially are the government of China. So this Politburo, which is the 25 of their top leaders, are then elected to the government. And then probably the most, or by far the most influential leaders come from within that grouping, and there's 7 of them. So the Politburo Standing Committee is 7 people who are by far the most powerful decision makers in China. Now, if we just look at the transition of those 7 people over the course of this leadership conference that they had a few weeks ago, starting off at the top. So Xi Jinping was the president. He's been that for 10 years now. He'd already paved the way going into this conference for another term. So that abolished term limits. And it was pretty clear that he was going to hang on to power going into this. So he stuck around. Then within the 6 other top 7 members, you had 2 guys who'd passed the mandatory retirement age of 67, so they weren't eligible to be re-elected. So you needed at least 2 new members coming in. But then what was probably the most uncomfortable part of this kind of consolidation of power and shift in ideology was that 2 members who were eligible for re-election and were probably the most moderate of the top 7 groups, so most aligned to kind of free market economic thinking, were kicked out. And so then you had 4 people that needed to be re-elected, the 2 past the mandatory retirement age and these 2 guys that had been kicked out. And the 4 people that came in were all very closely ideologically associated with Xi Jinping and had worked with him fairly closely in the past. So this was a little bit uncomfortable for us. You saw this consolidation of power and kind of a sharp shift in ideology away from this broad kind of Western democratic free market thinking. Now, having said that, we don't think all's lost in China. A few weeks after that, you had the G20 meeting where Xi Jinping and American President Joe Biden sat down and talked for a while. And the outcome of that, or the sort of comments coming out of that, was that Biden said, based on those discussions, both of them think there's no new Cold War coming out of this. So we're not, although they've ideologically slightly different, they think they'll find ways to work together, and this is not kind of a big bifurcation of world powers. And the other really good thing that came out of that was the fact that Biden, at least based on what he discussed with Xi Jinping, didn't believe that there was going to be kind of military action where China was taking on Taiwan from a military perspective. And obviously, Nolan talked about what's happened in Russia and Ukraine, and we've all seen the impact of that around the globe. So we don't want another one of these kind of regional military conflicts. And so the good news is it doesn't seem like any of that is imminent. And then the other good thing I would say about the Chinese economy is that it's operating well below its potential. So while the rest of the world has moved on from COVID-19 and we're kind of normalizing economic activity, China have sort of doubled down on this COVID zero policy where they just keep locking down their economy, and particularly their consumers are kind of locked up. They can't really operate normally. And so by our calcs, we think there's roughly kind of consumers are operating sort of 20% below their potential. So to the extent that we see these COVID protocols eventually unwinding themselves, and those of you reading the news would have obviously seen that people are getting a bit tired of being locked down in China, and we've had some protests over the weekend and into today. So to the extent that this catalyzes the end of these extreme COVID lockdown measures, we think there's a really good tailwind for Chinese consumers to catch up, and obviously that will knock on to global economic activity as well. And then I'm going to wrap it up by just talking about China in the context of South Africa. So I've got South African exports and imports on these 2 charts. The red line here is South African exports to Asia, which are by far our biggest export market. That's just over 30% of our exports go to Asia, and about 2/3 of those go to China. So pretty significant export destination for us. On the right-hand side, imports even more, Asia even more influential. So about half of what we bring into the country comes from Asia, and again, about 2/3 of that comes from China. So in terms of our domestic economy, China is really important for us. In terms of financial markets, as I said in the beginning, the US is really important for us. But from a trading perspective, both the Americas, including the USA, account for about 10% of imports and exports. So no real direct impact on our trading, but direct impact or much bigger impact on our investments. And I think that's a perfect time to hand over to Casey to talk about what's going on in our local market. Thanks, Casey.
All right, good afternoon, everybody. And thank you very much, Pete. As you guys have gathered, my name is Casey Delport, and I am an investment analyst here at Anchor Capital. So my real intent today to sort of round up the webinar is to take and really collate everything that both Nolan and Pete have discussed thus far and bring it down to the local level, really paint the picture of the South African economy, sort of key, pressure points that we are considering as we move into 2023. Nolan, if you could flick to the next slide, please. And I think the first sort of natural starting point is, of course, the inflation sort of outlook for South Africa. I mean, that has been a key talking point for most of the year, not just on the global front, but on the local side as well. And I think it's quite interesting that, if we consider our latest print, that after 2 consecutive months of easing, our annual October headline inflation rate surprised to the upside, actually printing at 7.6% year-on-year from 7.5% year-on-year in September. And, with fuel inflation already sort of known in advance and thus ultimately factored in, and food inflation sort of broadly steady in October, the upside surprise in this particular release actually came from core CPI. So core CPI inflation rose to 5% in October, up from 4.7% in September. And whilst the additional out-of-cycle survey for medical health insurance turned out higher than initially forecast, the overall rise in core CPI was fairly broad-based, adding to the signs that the sort of general inflation outlook is continuing to broaden beyond sort of energy and food price shocks as we've seen thus far, and is essentially becoming more entrenched. And while this sort of latest inflation print was indeed a surprise move on the upside, it is worth remembering that the October inflation print remains below the July peak of 7.8% year-on-year. Thus, we still expect headline CPI to continue to ease in the coming months. I think, that being said, the path of headline inflation will remain sensitive to volatile items such as food prices, Brent crude oil prices, and of course the exchange rate. For fuel inflation in particular, the strong adverse base effects are still likely to dominate, and this could see fuel inflation fall into the higher single digits by March of next year from that 30.1% print that we saw in October. But overall, we expect inflation to average around 6.7 for 2022, to from there onwards sort of drop around the 5.5% mark for next year, and then from there on out drop back to the mid-mark of 4.5% for 2024. So essentially what we're seeing is inflation remaining elevated for longer than initially anticipated, with a very sort of slow downward trend to come back down to more sustainable levels. Nolan, if you can mix the next slide, please. And essentially, this leads to the sort of second key point that, unsurprisingly, this interruption of the downward trend in inflation from the recent peak in July served to stoke the SARB's inflation concerns while, supporting its general approach in this rate hiking cycle of erring more on the side of caution and front-loading the interest rate hikes. Subsequently, the SARB's MPC voted in its last meeting of this year, which took place last week, Thursday, to hike rates by a further 75 basis points, taking the repo rate to 7%. For what it's worth, the prime lending rate is also now increased to 10.5%. And what we really see with this sort of final MPC announcement for the year is that the level of the repo rate is now above the level prevailing before the start of the COVID-19 pandemic. And, understandably, this interest rate hike will undoubtedly be met with some dismay by local consumers who already have to contend with the rising cost of living, coupled with the dampening effects of ongoing load shedding on our already somewhat stagnant economy. Notwithstanding, encouraging indications that the general momentum in global inflationary pressure is easing and the recent, striking retreat in domestic break-even inflation, this data arguably supports a persistently steep pace of rate hikes to sort of reach the neutral rate, a key milestone for the SARB, sooner rather than later. As the MPC regularly emphasizes, the committee tends to look through the first round effects of price shocks and focuses on the second round impacts, balancing the need to be both data dependent and forward looking as well. Really, with what we see, from this latest inflation print leaning towards a more sort of entrenched inflationary environment, the SARB will strongly be contemplating hiking to what, it deems restrictive territory, thus potentially continuing to push the repo rate above the neutral rate of around 7 or 7.25% before easing the current rate hiking cycle. We, however, maintain that further tightening into this restrictive territory is only necessary if the inflation forecast trajectory is lifted or, if there are significant and clear upside inflation risks with a very sort of high probability of materializing. So in other words, the tightening to date, is consistent with the prevailing outlook, and further rate hikes should really only be considered if the SARB believes that it is necessary to effectively take out more insurance with extra tightening against the inflation risks, taking into account that the earlier hikes than its model deems necessary is already a form of such insurance. And at the end of the day, such insurance is costly, although the governor of our Reserve Bank empathetically has stated that the cost of tightening is too much is lower than the cost of tightening too little. I mean, that can be debated, but that's perhaps for a presentation for another day. But we also see our governor also hawkishly state that the SARB will stop hiking when there is clear evidence that inflation has peaked and is declining sustainably to the midpoint of the target. So the crux here seems to be that the next decision will be very data dependent and that the SARB will likely continue to err on the side of caution, given that the market has generally sort of tended to be hawkish through the cycle and typically focused sort of on global, particularly US central bank action as guidance for the SARB sort of likely actions. We expect the market to discount another 25 to 50 basis points hike at the January meeting, but that's just simply for now. Again, there are two sets of CPI data releases to be considered before then, as well as the fourth quarter inflation expectation survey, as well as the resilience of the rand that really needs to be taken into account when sort of making these types of forecasts. So at this point, it might be a little too early to state just yet where we think the SARB will be going. Next slide, please, Nolan. And I think the next real sort of key issue to consider within the greater South African economy are the very many structural issues that are currently at play at the moment, chiefly being that of our failing SOEs. And one of the first primary candidates, of course, is Eskom. And, I think there will be sustained focus on Eskom's seemingly deepening operational crisis in the weeks ahead, well into next year. Concerns in this regard have been compounded by reports suggesting that there will be near continuous load shedding for the next 2 years, based in a large part on Eskom's near-term inability to afford running its open cycle gas turbines, which interestingly enough has actually cost around 12 billion rand since the 1st of April this year, just to keep them running. But luckily, last week for us, Petra SA provided a temporary diesel lifeline to Eskom, which enabled the return to service of the utilities' open cycle gas turbines. But overall, there are strong indications that South African consumers will need to brace themselves for a massive electricity price hike to be announced tomorrow. Nolan mentioned this earlier on in the presentation. We have NERSA coming out tomorrow, set to reveal its decision on Eskom's application for a 32% hike in average electricity tariffs from April of next year. NERSA, in this regard, has had limited room to maneuver for a significantly smaller price increase due to Eskom's winning of several court cases against the regulator in the recent past, after being granted much smaller price hikes than it was entitled to under that multi-year price determination methodology that it follows. Overall, expectations are for the price increase sort of from around between 25 to 30%, which would, be largely unaffordable to the average South African consumer at the end of the day. But on a more positive note, whilst Eskom's woes have indeed, deepened in this regard, I think it's important to remember that the legal framework for private power generation has been put in place. And in fact, the first licenses for private power producers to sell electricity back to the grid has indeed been granted. And, whilst this medium-term pain is not going to go away, the right regulatory framework at least exists now to address the power generation issues. So that is a more important step in the right direction. And I think another key issue to consider with Eskom is with regards to its debt relief, as announced in the recent medium-term budget speech in October. And, whilst the details of this debt relief are still to be announced, assumptions are currently centering around sort of annual transfers to Eskom of around 50 billion over the next 4 years. I think it's worth bearing in mind that government will also, separately need to provide cash support for the other sort of struggling state-owned enterprises that we're well aware of. This has already been provisioned for within the budget. And at the end of the day, I think this debt transfer plan is increasingly complex and it's not without risks. So as such, we believe that more clarity on the amount, timing, and the form of the support is needed before we can really incorporate it into sort of our base case and our forecast looking ahead. And I think, lastly, in addition, the debt transfer plan will not address Eskom's other challenges, such as weak operational performance, overdue receivables from municipalities, and below cost tariff increases. Then the other sort of key problematic SOE to consider is Transnet, which has really been quite in force in the media headlines of late. I mean, the SOE recently declared its sixth force majeure in 18 months after a coal cargo carrier was derailed in KZN, with the spillage causing severe blockages along the line. I mean, the day it's imperative that both our freight network and our ports are functioning in the economy at the end of the day. South Africa is an export-driven economy. It brings in very, very valuable revenue streams to the country, and we have to be able to get our mining output, our agricultural output out of the country and where it needs to go. But I mean, aside from these clear operational issues, if we consider Transnet's actual financials, it's interesting that the parastatal swung to a 5 billion rand profit in the 2021-2022 financial year from an 8 billion loss in the previous financial year, owing to property and asset reevaluations of about 11 billion rand, and yet has a 27 billion rand underspending record on its property and asset maintenance for the last decade. And this is all happening while Transnet's volumes have dropped by 24% in the last 5 years. In the entity's general freight division, the average monthly gross tons per kilometer per locomotive key performance indicator shows a 33% drop in efficiency over 5 years. So, despite the estimated 1 billion rand a day of losses in exports and import activity experienced during that 11-day long strike at Transnet's ports and rail operations in early October, the latest estimations indicate that Transnet, in fact, continues to cost the South African economy millions of rands on a daily basis. And, at the end of the day, if there is an inefficient network industry, it directly undermines upstream growth to the rest of the economy. So really, what does this all mean? I think at the end of the day, South Africa's economy is growing less than 2% a year, and this has largely been impacted by these important but failing SOEs. Typically, in the local economy, material job creation has only occurred when GDP growth approaches 3% per annum. Thus, the South African economy is simply not growing at an adequate rate to sustainably boost long-term employment prospects for South Africans. Again, that ties into, another very serious key structural constraint to the South African economy, and that is our prevailing and very serious unemployment issue. Next slide, please, Nolan. And then really just to sort of, end off for the day, let's move on to my sort of last section, and that is South Africa's, political economy and what it really sort of means as we move into 2023. Up until recently, we were more concerned on the political front. However, that has sort of quietened down in the last few weeks. In fact, we had the ANC Electoral Committee reveal last week that President Cyril Ramaphosa is leading the ANC branch nominations for the party presidency. Important to remember that the ANC conference is coming in December, and that really has sort of been the key talking points. Thus far, Ramaphosa has received a majority of 2,037 nominations from branches. He will still, however, face a challenge from our former health minister, Zweli Mkhize, who has received 960 nominations at this point. Montashili remains sort of a shoo-in for our deputy president. He's received 1,791 nominations thus far, with the next incumbent only coming around, I think, 427 nominations. So basically what we are seeing is a lot more sort of calming on the political rhetoric from the ANC side, and stability within our major ruling party in the day is important for the South African economy, given the various sort of issues and cruxes at play. We also take a lot of comfort that power seems to really have been cemented and shifted away from the more problematic RET fraction to the more sort of moderate side of the ANC. And yeah, then that point, that is my piece for today. If I can hand back over to you, Dale.
Thank you, Casey. Guys, we're going to now open up for questions. So if you could please type your questions in the Q&A function. If Peter and Nolan, I could ask you to please put your cameras on, and we're going to try to get through as many of these questions as we can. Peter, first question for you. What is your view of the current protest action? Could this be the beginning of the end of economic disruption? Sorry, I'm assuming that's a China question.
Yeah, sounds like it. So certainly it's been pretty interesting. I think, for those of you who are particularly interested in this stuff, I'd encourage you to listen to The Economist. They put out I want to say about an 8-piece podcast called The Prince, which goes into intense detail on Xi Jinping and his history and background and stuff. So really interesting. And one of the things that I took away from that was that Xi Jinping was intently concerned about uprisings. So he thought that Tiananmen Square in the late 80s was handled very well. So we can't afford to kind of lose power. So he's a leader that's more interested in power than he is in kind of enriching himself. And so to that extent, anything that potentially disrupts his ability to hold on to power is seen as problematic. So I don't know, my reading of it is that it's unlikely that he'll tolerate these protests. And so I expect to see a pretty strong crackdown on it. Unfortunately, I think that means that you kind of got to double down on this ideology of COVID zero. So it probably means that lingers around longer than we had hoped for. And we could have potentially have just seen this kind of fade into the background without losing political face had this not happened. But yeah, so certainly going to be very interesting to see how this all pans out. My expectation, as I say, is that we'll see this kind of protests clamped down on pretty harshly, and we'll be back to kind of business as usual.
Nolan, this is a crystal ball question for you. What do you think the value of the rand will be in 2023?
Yeah, getting the value of the rand to get right next week these days is a problem. But Anchor in our navigator, which we would have published in about October, was talking about seeing the rand strengthen back to 1650. And our perspective was that historically what you've seen and what we've seen this year has not really been a weak rand. The rand actually for long periods strengthened against the euro, it strengthened against the pound. What we've seen is a strong dollar. And on the currency crosses, the rand has looked a lot weaker against the dollar and has kind of kept pace with everybody else. That strong dollar historically has occurred when you see interest rate hikes like we've seen this year. And I'm talking about interest rate hikes in the USA, that strong hiking cycle. Peter Little had the charts up earlier. When you look back in history, that strong dollar has typically, the end of the strong dollar has typically coincided with the end of the rate hiking cycle. We fully expect that the US is going to continue to hike. But as Peter Little said, it's about 1% more to go. They could get there in Q1 next year, arguably in Q2. But the point is we're going to get there next year, probably in the first half. from there on, you would expect that the rand starts to regain some lost ground. Now, the rand is one of those currencies that, in terms of strength, it sort of strengthens by climbing up the stairs, and when it weakens, it just falls out the window again. So it's going to be a protracted climbing up the stairs to recover, and that's why we don't expect a full recovery. We're thinking, somewhere around 1650 next year, with more of the recovery sort of spread into future years.
In the vein of tougher questions, Casey, I don't know if you'd like to venture a comment on this. It could be a little bit of a rhetorical one. Your comments on Eskom increasing tariffs yet reducing services.
I think that one answers itself, like you said, very much a rhetorical question. I mean, we all South African consumers at the end of the day, we're all customers of Eskom, and to have, to stomach massive tariff increases while having less and less electricity feeding through to our homes is not particularly palatable. And I don't think we can blame, the society at large at the moment in South Africa for being unhappy with Eskom.
Pete, a question for you. This is a long one, so you're going to have to listen. Considering China's influence on Africa and South Africa, their trade may support South African economic metrics in the short and medium term. However, multiple infrastructure contracts awarded to China will add further unemployment pressures, most likely employing Chinese alone, which is a dire problem and perpetuates the inequalities so visible in SA. Your comment, please, as politicians seem purposefully to ignore these issues to win short-term goals beneficial to themselves. Sorry, Pete, that's a very long question.
Yeah,
hopefully you got it.
There's a lot in there. So, I mean, I guess the kind of underlying rhetoric is that we expect the government to employ Chinese corporates and Chinese labor to build infrastructure here to enrich themselves relative to the employment prospects of South Africa. I would say, that's a tough one. On the one side, it's critically important for us to ensure that we have decent infrastructure. That's a driver of productivity, which is a driver of growth, which is ultimately what will create jobs. So getting our infrastructure right, be it Eskom and the electricity, be it roads and ports, all of these things. So kind of erring on the side of getting the infrastructure right is probably the right thing to be doing. I would say to the extent it's done for nefarious reasons to try and get kickbacks, I don't really have a strong comment on that. I think a lot of government business is done with sort of greasing the wheels needing to be greased. What I would say is obviously our local labor laws are pretty supportive of employing domestic people. So I think it will be very hard for Chinese corporates to come in here and kind of run roughshod with our local labor legislation, which requires a certain amount of local employment for to win government tenders. So, to the extent, not saying it can't happen, but certainly to the extent that the rule of law is followed, it's very hard for them to kind of come in here and build infrastructure without employing local labor. So I would say on balance, it's probably good for us, A, to get our infrastructure right, and B, even if they employ only a portion of local labor, it's better than no employment at all. Hopefully that answered it.
Thanks, Pete. I think it's a great answer. I'm going to ask this next question to both Peter and to Nolan. I'm going to split the question. So the question is, how do your views position assets currently, locally and globally? Are SA valuations clearly a slam dunk, as some asset managers make it out to be? So I'm going to split the question and ask Pete if you could talk to some of the valuations that may be looking juicy in the market, maybe locally and globally. And Nolan, if I could maybe ask for what your fixed income views are going forward in terms of the right fixed income assets to position into for next year. So, okay. Pete, you want to start us off?
Yeah, let me have a first crack at that. So as I kind of alluded to in my presentation, the global markets, certainly on the equity side and to probably even greater extent on the bond side, I think have already pre-positioned for a pretty bad outcome next year. So valuations are pretty low. They are on kind of elevated earnings expectations, but to the extent that we have a fairly mild recession next year, I think equities have priced quite a lot of that in. in the context of the local market, so I think there's a couple of things to say here. Like, if you have a risk-off event, kind of what's happening to the earning potential of the fundamentals of the local companies almost doesn't matter. You just see liquidity get sucked out of the system, and we're probably on the sharp end of taking the pain of that as an emerging market. But I think a lot of that has already been taken. So our stock market, and particularly our domestically focused companies, are already on the cheap end of the spectrum. I think what we've interestingly taken out of most of this year is, while global corporates are really kind of deer in headlights in this environment with high inflation and recessions potentially coming and all sorts of conflicts happening, our local economy, our local corporates are kind of business as usual, right? They're used to operating in an inefficient environment with negligible growth and high inflation. And so to the extent that they're operationally able to deal with that, I think they'll kind of muddle through this as best as anyone can. And frankly, they're on the kind of cheap end of normal for that. So I think they're well priced to kind of work their way through that. As I say, that's not to say there won't be a few wobbles along the way as liquidity gets sucked out of the system, but with a kind of 1 year plus view, I think we're kind of well positioned locally.
Nolan?
Thanks, Del. Thanks, Pete. I'd actually agree with Pete. I think that looking at the domestic market, fixed income is attractively priced. You're earning circa 10% on domestic bonds. It looks decent. You've got offshore, you're earning arguably 5 to 7%, depending on where you're going in dollars. Again, decent, but there's probably more hard yards to do in dollars. In the context of how I'm looking at the markets, I think that when we get to that, hey, we're through this, the dip wasn't as bad as we expected, companies are actually going to survive and start growing again, economies are going to start growing again, there's that relief rally that you don't want to miss out on. I think that relief rally will be quite broad-based, so you'll definitely get some of that offshore, you'll definitely get some of that domestically. I'm not necessarily a subscriber that domestics are going to rally that much further than, in that sort of environment. But in the context of, if this just drags on for another year or two, I think South African prices are probably a little bit more compelling.
Nolan, I'm going to try to squeeze in one or two more quick ones. I know we are at time. Are we going to see a higher local bond yield before they drop next year?
First comment is, I think that it is more likely than not that we do see bond yields drop next year. The US bond yield kind of price, becomes the building block or the sort of prices bonds across the globe. So we follow the US. They set the market. US rates are going to peak. Peter Little's talking about a recession, a slowdown. That's the type of environment where you start to see bond yields coming down again, and potentially coming down quite quickly, certainly in the US. And we will eventually, go through a bit of volatility, but find ourselves with yields sucked lower as well. So I think the direction of travel is probably lower next year, but that's not to say it's going to be a smooth ride. And could we see a bump with higher yields than today? Yes, certainly is plausible.
Pete, last question. Do you foresee global exposure increasing through time as the JSE listed stocks are dwindling, reducing opportunity, and offshore offers better risk attributes?
Yeah, I mean, I think certainly the opportunity set offshore in terms of what you can invest in is pretty, it would make sense for most investors, depending on the size of their assets and their local income requirements, to diversify a decent portion of their equities offshore. I think, kind of as I alluded to in my previous answer, there's still good opportunities. There's still good management in South Africa. It's a relatively inefficient market. So to the extent that people can come in and kind of take advantage of those opportunities, there's still a lot of money to be made here. And although the JSE has kind of been shrinking a little bit, we still think plenty of opportunities, particularly on the sort of mid to smaller cap side of the economy, to invest in good corporates making decent profits and figuring out how to grow them in a tough macroeconomic environment.
Thank you, everybody. We are at time. I'd just like to take this opportunity to wish all of you well for the festive season. I hope you have a relaxing break, and those of you who celebrate Christmas, have a Merry Christmas, or however you celebrate, and a Happy New Year. From all of us at Anchor, thank you for attending Essentials, and we'll see you back in January. Goodbye, everybody.